The importance of banks, part of our lecture series on banking. In this video, we'll discuss two reasons why banks are important. First of all, that banks match small borrowers and savers, and second of all, that banks create money. I mentioned in the previous video that banks are financial intermediaries, and one of the reasons that banks are important in our economy is that banks are the main financial intermediaries for small savers and small borrowers, especially for small businesses. The financial intermediary that you are likely to have the most contact with for the rest of your life would be banks. And so that's why they are central to the economy. Because banks are institutions in a community, they have an information advantage over individual investors in that they know a lot of the small businesses in the community and can figure out which of these businesses are worth loaning to and which are not worth loaning to. So this information advantage is one of the reasons why banks are important. Because banks collect a lot of deposits from a lot of different savers and then loan that money to a lot of different borrowers, um, banks are less worried about one individual saver or one individual borrower running into problems. These pooled resources of a bank give the bank an advantage in bad times to keep investing and keep being available, even if some borrowers or some savers run into problems. Because banks are this sort of centralized location, because banks are this financial intermediary, banks are also very good at facilitating payments so that when you use your ATM card or your parents write a check or you make some sort of other financial transaction, that's usually going to be through a bank, and that bank making sure that the people that you pay are getting the payment and making sure that your account is debited or making sure that you're getting into payment and someone else's account is debited. So banks also facilitate payments as a result of being these financial intermediaries. What this means is without banks, the economy comes to a halt. And this is a theory that was first put forth by Ben Bernanke back in 1983. And he was looking back at the causes of the Great Depression, which was the most severe US financial crisis. And people debate what the cause of the Great Depression was and what made the Great Depression so severe. Ben Bernanke's theory that he puts forth and offers some evidence for is that because of these functions that a bank does that I mentioned in the previous slide, not having those banks in the community led to the economy coming to a halt and fewer people investing in useful companies. So one of the ways we see this is that in 1929 there were about 25,000 banks in the U.S. Nowadays there are many fewer banks in the U.S. thanks to consolidation. Nowadays there's about 5,000 banks in the U.S. But back then there were 25,000 banks in the U.S. in 1929 before the crisis, and then at the depth of the crisis, the lowest point of the crisis in 1933, there were 14,000 banks. So losing around 45% of all the banks in the country helped grind the country's economy to a halt and led to the most severe financial crisis that the U.S. has ever had. So that's the first reason that banks are important. Let me tell you the second reason why banks are important. Banks are important because they create money. They create money by accepting deposits and making loans. Now, this is going to be a concept that many people have difficulty with, so it may take a couple viewings of this part of the video to really get it, but let me step through the steps that show how banks create money. And to do this, I'm going to look at some balance sheets. And if you didn't watch the video on GDP, I'll tell you that a balance sheet is one way that economists analyze economic activity as well as other people. On a balance sheet, it's called a balance sheet because the left side of the balance sheet and the right side of the balance sheet should always equal each other. In the case of banks, assets of the banks are going to be on the left and liabilities of the banks are going to be on the right. So we're going to look at some simplified bank balance sheets. So imagine that there's a bank called the First Bank of Brandeis, and that the entire economy is just $1,000. $1,000 deposited in this one bank. If $1,000 is deposited in this one bank, the assets the bank has the $1,000 in cash that it keeps in its safe, and its liabilities are the $1,000 it owes to the depositor. If the depositor shows back to the bank has to be able to give the depositor back the $1,000. So this is just $1,000 shown on the First Bank of Brandeis balance sheet. Um, if the bank keeps the $1,000 in the safe, this is what's known as full reserve banking. The bank can completely cover the depositor when the depositor comes in and wants all the money back at once. The bank, in other words, has enough cash on hand to satisfy every depositor for the entire amount. In this case, the total size of the economy is $1,000. That $1,000 is sitting in the safe in the bank, but the depositor has full access to that $1,000. And this is full reserve banking. No money is created under full reserve banking. What happens more often with banks is what we call fractional reserve banking. Banks realized that they didn't have to have all the money in storage all the time, and could in fact put some of that money to use. So imagine that instead of the First Bank of Brandeis keeping all 100% of the deposits on hand, the bank keeps 20% or $200 of deposits on hand, and then takes the other $800 and loans it out to borrowers who will pay it back at a higher rate of interest than the bank will give to the depositor for depositing money in the bank. So the bank makes a profit on the spread between the rate of interest it gets from the borrower and the rate of interest it pays to the saver. Nowadays, the rate of interest it pays to the saver is very close to zero, and the rate of interest it pays to the borrower can vary from 2% to 20%. Now, the interesting thing here is that although the economy started with $1,000, and the depositor thinks that they can still take $1,000 out of the bank, in fact, there is now $1,800 in the economy because the bank has taken some of that cash and loaned it to someone else. So the amount of money in the economy now is the $1,000 that the depositors think they can have, and the $800 the bank loans out to someone else. So the economy has grown. The money has been created from $1,000 to $1,800. Now, this is a computer science term, but fractional reserve banking is what we would call recursive. If people are using banks, then this fractional reserve can go on and on. Imagine that the person that borrowed this $800 then puts that money in a second bank, the Second Bank of Brandeis. So now the Second Bank of Brandeis has deposits of $800 and cash reserves of $800. And now this Second Bank of Brandeis can loan out $640 and keep 20% on hand. And now the total amount of money in the economy is the $1,000 of the initial deposits, the $800 of the Second Bank of Brandeis deposits, and the $640 in the loan. So now the economy has $2,440 out of the original $1,000 investment. In fact, we can imagine a third Bank of Brandeis that would do the same thing. So, in other words, banks, by only keeping a fraction of the money on hand, can create money by lending that money out and having it do double duty as money that is owed to the depositors, but money that the borrowers can then use to finance their business or to do whatever it is that they think would be valuable with that money. Now, as you can imagine, this idea of fractional reserve banking has a downside. And the downside is if too many depositors want their money back, then this can cause what we call a bank run. And this is a picture of a bank run in 1930. You can see on the left-hand side of this picture, if you look on the second story, that bank is called the Bank of United States. And that may not sound very grammatical, but that's what the bank was called, the Bank of United States. And it was one of the more publicized bank failures in 1930. These people that are in line are all in line to withdraw their money from the bank. They're depositors that the bank owes money to. And the reason that there's a big crowd at the front of the bank is because the bank is not letting anyone in, because the bank knows that it does not have enough cash on hand to satisfy all of the people that want to take their money back out. So the downside of fractional reserve banking is that banks become less safe for people to put their money in because if too many people show up at once, it's a bank run. Nowadays, we have deposit insurance, which means that the government backs up the deposits you have in a bank, so that if the bank does fail, then you are entitled to that money back. But this does not mean that bank runs are impossible. Let me tell you a story about 2008 and the 2008 financial crisis. So this is the depths of the financial crisis, September 17th, 2008. And this is from a journalist from the Financial Times. And the journalist of the Financial Times wanted to go to Citibank, take out his money because he thought the bank was unsafe, and he also had more than the insured amount in the bank. So your deposits are insured up to, I think nowadays, $250,000 per person, but back in that time there was $100,000, and so some wealthy bankers had more than that in the bank, so they planned on taking money out of the bank. But when this journalist went to Citibank in 2008, he found a long line of well-dressed Wall Streeters, and Chase Bank next door was also full of anxious-looking people wanting to withdraw their money. In fact, there was a bank run happening, and that the people that were panicking were the Wall Streeters who best understood what was going on. Now, this journalist decided not to publish a story that would have told about a bank run on Wall Street because he believed that this would cause panic. But you can imagine that another journalist would make a different ethical decision that people should know that these bank runs were happening, and that this would have developed into um, a more widespread bank run and more widespread mistrust in the banking establishment. So when people say, "Oh, the banking runs can't happen now because of deposit insurance," this one guy stopped a bank run from happening in 2008. So, um, but the point is that through this fractional reserve banking, banks implement the monetary policy of the central bank. So if the central bank wants to increase the money supply, it does that by acting through banks. It is not by printing money. So one of my least favorite phrases is inflation happens because we print money, and it's just not true. We haven't printed money as a way to implement monetary policy in a very long time. Instead, the central bank, the Federal Reserve in the United States, acts on its monetary policy, acting through banks, and whether banks create more or less money from the money that the banks have on hand. So, banks match small depositors and investors, and that's a crucial thing they do in the economy, and crucial to the overall well-functioning of the economy. And banks create money through fractional reserve lending. Thank you.